The markets are open and we can see they are starting to pick up slightly from the last few days where in fact we got consecutive red performances, but we do notice investor sentiment is still sitting on the edge of extreme fear, and today we want to cover a stock that Wall Street themselves believe have more than 50% upside just over the next 12 months, and that is Robinhood, which is up around 220% over the last year, massively outperforming the S&P, but like the majority of stocks over the last week, they have had a difficult period where in fact they were down over 12%, and Wall Street believes now is the time to buy this company, which as we can note is at the upper end of the 52-week range, and we do also get to see that buy rating. Now, for those that don't know what the company does, they are in fact a commission-free trading platform that allows users to buy and sell stock options, ETFs, as well as cryptocurrencies, and they offer a user-friendly mobile app and web interface, making investing accessible to beginners, and they generate revenue through payment for order flows, interest on uninvested cash, and premium subscriptions like Robinhood Gold. They also provide features like fractional shares, recurring investments, and in fact retirement accounts. And we can see in one of their latest earnings the breakdown of their top line as well as the other segments. In fact, the large portion of their total top line revenue comes from options at 182 million, and we can see in a close second we have cryptocurrencies at around 81. They did also release their earnings not too long ago, where upon the release of that their shares were up more than 10%. They reported 1.01 billion for the fourth quarter revenue, and we can see a lot higher than what the markets were anticipating of 946, and EPS came in at just over $1, again significantly above market expectations of 42 cents. Very impressive to note. Investors clearly love to see that, and you could argue the dip we have just seen was a great potential buying opportunity. Now, if we take a look at their last 4 quarters, they did outperform on 3 of them, giving them a 75% track record, and out of the next 4 quarters, they are expecting 3 of them to be growth. In fact, the next quarter, Q1 2025, triple digit 112%, and based on the EPS estimate for this full year of 2025, we can see they're trading at a forward valuation of just over 32. Now, if we compare that against others, you can straight away see they get a D on the grading, but the sector median comes in at around 11.2, so you are pretty much paying quite a significant premium for Robinhood. One, we're going to look through our own valuation process, but as we stated, and we will show you as well, Wall Street do see this as a great buying opportunity. But no matter which valuation metric you look at, whether it's price to sales or even price to book, this company does trade at quite a severe premium to the overall sector. In terms of growth, very promising though, with their beat year on year 58%, a lot better than the sector at 5.9, also significantly above their 5-year average of 52. Forward looking, nearly 30%, significantly better again than the sector at 6, a lot better than their own 5-year average, and the EBITDA growth coming in at 64%, again significantly above the sector at 10.75. Now, one thing that does let them down, and hence why they don't get an A rating, is the earnings per share only expected to grow at 7% over the next 3 to 5 years, with the sector coming in at 9.93. Then we move on to their profitability, where they get a B-. Gross margin, 91%, a lot better than the sector at 60.4, a lot better than their own 5-year of 75. Bottom line, also very strong, 48%, significantly above the sector at 22%, and also better than their own 5-year average, where they were in fact losing money at negative 82%. And we can see over the last 12 months, their cash generated from operations has actually been negative 157 million, with the sector comparative at 148 million on a positive basis, and their own 5-year, whilst negative, a smaller amount at 25 million. We'll also show you against others in the sector over the last 12 months in the investment banking and brokerage sector. They have been the best performing, in fact outperforming even the second place by quite some distance, up around 207%, and like many stocks today, they have rebounded up nearly 10% given the drop that we have seen over the last few days. In terms of what the institutions are doing, 93% ownership, 3.35 billion worth of sales over the last year, but a significant amount worth of buyers in comparison, nearly twice as much at 5.12, and we also notice in the most recent quarter, institutions continue to buy more than they are selling, so they are definitely very bullish on Robinhood overall. In terms of insider ownership, fairly high at 20%. We see 390 million worth of sales over the last year, with the most recent one in fact being in 2025, where we note 126 million worth of sales. Full transparency, we'll show you who these insiders are. Most recent one, 21st, so just a few days ago, insider selling 123,000 shares, netting them $6.9 million. Whilst we do show the information, for those that want to know, this isn't something we typically see as a bearish signal. They sell for many reasons, personal and financial. Now, a few highlights we want to point out from their latest investor presentation from just that earnings from a few weeks ago. First one, their funded customers has been continually increasing quarter on quarter, at least over the last few years. It's up 1.8 million on a year-on-year basis. Their gold subscribers continue to increase, with the adoption rate only getting higher, sitting at 10.5% in the latest quarter, again up 1.2 million. Assets under custody again increasing. We're noticing an 88% year-on-year growth point, and net deposits, something we want to see continue to increase, again looking very strong at 16.1 billion. In terms of their net revenues as well, equally as impressive as the other metrics, up 115%, triple digit on a year-on-year basis. And we also like to look at margins, very important when we want to identify high quality companies. It's gone from 28% at the end of 2023 to the end of 2024 sitting at 60%. So not only increasing their revenues as we can see, but also their margin looking very healthy, very strong. We love the growth rate, and their bottom line income, the same to be said, going from 3 cents diluted EPS at the back end of 2023 to now sitting at just over $1. And as we can see here, funded customers have increased. We are seeing a lot of records being broken by this company, as you will come to see. 25.2 million at the end of the most recent quarter. Assets under custody, again a quarterly record of 193 billion. Another record here with net deposits around 16 billion at the most recent quarter, and they translated that to a 42% annualized growth rate, and just over the last year an increase of 49%. Trading volume is very important for a company in this industry, continuing to increase as they do look to gain market share as noted. We are seeing triple digits on the equity notional volumes, 61% on contracts, and 455% on cryptocurrency. One thing we always love to see, companies returning excess cash to investor pockets. One way that Robinhood does this, they don't pay a dividend, but they do a lot of share repurchases. In Q3, so just a few quarters ago, they announced a 1 billion share repurchase program, something that we do hope they can continue. And in fact, at the end of the year, they have deployed around 1 quarter worth of that, 257 million. And we can see it here from another graphical basis in terms of the growth on a year-on-year perspective. And finally, for those that want to see the close out to the year end, everything is pointing in the right direction for Robinhood. And that is why we are covering it today, because clearly institutions as well as Wall Street love this company. Now we want to flag their top line revenue. Yes, it has been increasing over the longer term, as we can see, whilst a little bit inconsistent. Just from 2019, going from 278 million to now just under 3 billion. But always good to see their bottom line net income. What does that tell us about a company? And the story to be told here is there's a lot of inconsistency, but actually they haven't reported a bottom line net income for that many years. We noticed in 2020, although fairly marginal at 7 million, and then 2024 at 1.41 billion. So something we would say just to keep an eye on. And then we always like to do a very quick health check of a company. Total cash versus total debt, where their cash again inconsistent, which isn't typically an issue. We notice it go from 644 million in 2019 to now at around 4.3 billion from that latest quarter. But as always, in isolation, one number here does not give anything away, so we compare it to their total debt numerically and directionally, which has increased from the period, going from 712 million to 7.7 billion, not too far off their cash. So at the moment, there is no massive red flag that we can point out. And then we look at other underlying metrics of a company that we typically like to look at right across the board. We can see their free cash flows fairly inconsistent over the next 12 months, expected to grow though to around $1.64 per share. Sales growth, again, inconsistency, but for the majority of years, we are seeing some very strong double-digit numbers. 58% just in 2024 alone. And shares outstanding, while we did hear about that authorization of the share buyback program, they have diluted your position over the last few years. But remember, if a company does dilute your position but can outperform the S&P, then it probably isn't a major worry. Now, return on equity, we do notice it has been negative for a number of years. As we did in fact see, there wasn't that many years where they reported a profit, so this does make sense. 2024, 19%. Typically, we want to see a minimum of 10, and that is a very good sign. But again, we just want to see a bit of consistency with the company. Now, before we jump into our own valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to February's undervalued stocks, 45 of them, as well as information including how much upside Wall Street themselves see over the next year. And you can grab a recently released copy of 32 stocks that Wall Street believe have the most upside right now in the S&P 500. So click below, you can sign up and read straight away. Now, our intrinsic value today comes to $24 based on these two models, which we will just run through. In terms of the other two models, well, very obvious, they don't pay a dividend, so we are unable to use this. And for companies in this industry, a DCF isn't typically applicable. So we'll run through them and then we'll talk about Wall Street themselves. In terms of Graham's valuation, this is one of the reasons why you could argue it's not typically a great one to use for a growth company, but we'll show it. Whether or not you want to include it yourself, you can always remove it. We have the stock ticker symbol, the earnings per share, growth rate that we covered, AAA corporate bond yield, to give us an intrinsic value at around $17, which based on the current market value does give us an overvaluation signal. Remember though, we don't look at any one of these models in isolation. Then we have the multiples model. Companies in a similar sector and size, their average P multiplied by Hood's 1.43, giving us $32, which is another overvaluation signal. So the average today at $24, even if you just wanted to use the multiples valuation, we are getting to the conclusion that right now this company is trading above what we see as its fair price. In terms of a margin of safety, typically on this channel we'd like to use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, then it would be a buy at around $22, but this is highlighting right now, based on our assumptions, the inputs and outputs you have seen, this company does look to be trading above its own fair price. And don't forget, you can always grab a copy of this model, run through your own numbers, whether it is Robinhood or any other companies, by clicking on that pinned comment below. As we said though, Wall Street themselves see this as a very strong buy. They note over 50% upside over the next year, and it'd be great to hear your thoughts on Robinhood in particular. If you believe this company is a buy like Wall Street believe, if you believe it is a hold, or in fact you do see this as a sell right now. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well, where we cover our weekly buys and sells, and given the dip, we have made some purchases, so do come along. As always though, have a great day, and we'll see you all on the next one.